Our next objective is to look at financial ratios. Financial ratios are found in your text under Chapter 3, which is called the Financial Analysis chapter. We're really going to look at 4 types of financial ratios: profitability ratios, asset utilization ratios, liquidity ratios, and debt utilization ratios. As we look at these ratios, you learn a lot about a company. Under profitability ratios, did we or did we not make money? Asset utilization ratios, how hard are our assets working for us? How well are accounts receivables working, inventories, and fixed assets? Under liquidity, how well are we positioned to pay bills and maybe to make investments? Finally, debt utilization ratios tell us how indebted we might be. So we're learning under financial ratios whether or not we're making money. Are our assets working hard, or are they not working as hard as we might like? Are we liquid, or are we able to pay bills? And how indebted are we, and how well are we servicing that debt? So we learn a lot by looking at financial ratios. Here's a couple of profitability ratios. Profit margin, for instance, where we measure net income relative to our amount of sales. In this case, you see Saxton Company had a profit margin of 5% versus an industry average of 6.7%. So 5% is a reasonable margin, but falling short of industry average in this case. Return on assets, we measure the amount of net income we're generating relative to our total level of assets. And in this case, this is a pretty strong return on asset number of 12.5% for this company. $200,000 divided by a fixed asset balance of $1.6 million, 12.5%. That's a strong return on asset number. Return on equity measures how successful we are in generating net income relative to the amount of equity that's inside the company. And in this case, $200,000 of net income divided by stockholders' equity of $1 million gives us a ROE, or return on equity, of 20%. That's a favorable return. So that gives you a flavor on profitability margins, where we've looked at profit margin, return on assets, return on equity. I advise you to look closely at the DuPont analysis method discussed in Chapter 3. Basically, it shows us, as depicted in this diagram, where we have results for Walmart and American Eagle Outfitters, that you can have a lower profit margin, but if you have high asset turnover, as in the example of Walmart, you can actually generate a significant increase on return on equity by taking a lower profit margin and turning assets over more frequently. American Eagle Outfitter had a higher profit margin but turned its assets over less rapidly, resulting in a lower return on equity. Make sure we're familiar with the DuPont analysis method, please. Under asset utilization, how hard are your assets working? Typically, we look at receivables and inventory as 2 commonly used methods. First calculation, receivables turnover. If you had credit sales in a year of $4 million, and on average you had a receivable balance of $350,000, then you have turned over your accounts receivable balance 11.4 times. That's a reasonable level of performance. If you get to the point of turning over your inventory, and this is a generalization, once a month or 12 times a year, you've done very well. In this case, you can see the industry average was 10 times. Saxton Company had a turnover rate of 11.4. At 11.4 times, that means it takes 32 days on average for Saxton to collect an accounts receivable balance. That, again, is a successful measure as compared to industry average here of 36 days. Inventory turnover for Saxton Company takes our level of sales of $4 million divided by the average inventory balance of $370,000. So inventory turned over nearly 11 times. For Saxton Company, that's a favorable measure, as the industry has only had inventory turnovers of 7 times. You can do the same in measuring fixed assets or total assets and determine what type of fixed asset turnover you have or total asset turnover you have. Liquidity ratios measure how well we're positioned to pay our obligations. We like to look at the current ratio. Current assets are all those assets ready and available to meet your obligations in the upcoming year. Current liabilities are all those obligations that are due in the next operating cycle or the next year. By factoring current assets divided by current liabilities, we have for Saxton Company a level of 2.67 times. That's a reasonably good performance for Saxton Company. They have $2.67 available for every $1 of liability that they have, both of them being current. The quick ratio or asset test is the same approach on measuring current assets versus current liabilities. It's just that you subtract from current assets the inventory balance. Debt utilization measures total debt versus our total assets. And on Saxton Company, you can see that a total debt of $600,000 divided by total assets of $1.6 million gives us a debt to total asset result of 37.5%. In this case, a little higher than the industry average of 33%. Second calculation, times interest earned. How often are you earning a level sufficient to pay your interest? And in this case, Saxton has accomplished income before interest and taxes of $550,000 divided by an interest obligation amount of $50,000. We get a result of 11 times. That's quite reasonable. You've earned your interest on your obligation 11 times in the course of the year. That puts you in a comfortable position to pay your interest, which of course only needs to be paid once. Fixed charge coverage is the same approach. It's just that we're going to add in leases and other obligations as we calculate the amount of income we're earning and generating and making available to pay fixed charges or the interest on our debt plus lease obligations. I'm going to move through this slide. Ratio analysis causes us to, well, we've been sort of doing this as we went through our slides. We look and see that profitability for Saxton was a little weaker than the industry average. However, return on assets was stronger. Return on equity was stronger than the industry average. Receivables turned over very favorably. The average collection period was shorter than the industry average. Inventory turnovers were favorable at almost 11 times versus 7. Fixed asset turnover was a little less favorable, but close. Total asset turnover was favorable. The current ratio is favorable at 2.67 times versus an industry at 2.1. The quick ratio is favorable, 1.43 versus 1. Debt to total assets, the company is a little more indebted at 37.5% versus the industry average at 33%. However, interest, that was the earnings of interest through operations, is strong at 11 times versus 7 for the average. And finally, fixed charge coverage is reasonable at 6 versus 5.5 times for the industry average. This last slide shows us that we often will look at ratios over time rather than comparing them just in one time period. And this gives us an idea as to how we're trending. And that is a brief discussion of financial ratios from Chapter 3 in your text.